High yield is not equities and drag. It has far better downside protection, far lower losses. It doesn't offer the upside, but it does offer you a very attractive yield for low downside. It's its own entity and should be thought about like that.
Welcome to Fixed and Floating, the credit podcast. My name is 𝗙𝗶𝘅𝗶𝘴, and in each episode, we explore the forces shaping credit markets. Today's guest sees high-yield investments fundamentally different than most people. While many treat it as a lower volatility alternative to equities, he argues credit is fundamentally different. It's a saving vehicle with capped upside and defined risk, not an equity replacement. I'm very pleased to welcome Greg Obenshain, partner at Verdad Capital. Greg, welcome to the show.
Thank you for having me.
Before we dive a bit deeper, let's start with your story. Greg, you spent about a decade managing high-yield fundamental portfolios at Stone Tower and then Apollo. What was the moment or insight that made you think, I need to rebuild this whole process quantitatively?
Thank you for having me. And as an analyst and portfolio manager for about 10 years, as you said, one of my favorite things to do was, or the most useful thing I did was to build comp sheets, right? And traditional credit analysis, where in the columns you have the companies, down the rows you have the credit metrics, and then you rank the companies from best to worst, from left to right. And I'd highly recommend that any analyst listening to this do that. It's an incredibly good way of sorting companies, and it's very effective. It's how I did the work for years. The problem was that once I started managing larger portfolios and across different funds, I couldn't do this anymore. There were too many companies, too many metrics to follow. And so at some point I found myself turning to spreadsheets and databases, trying to automate the process, which was very difficult. And at some point I had an Excel database and a MySQL database. But then one day there was a guy on the desk who was coding in Python. He was a quant that we'd had for a while. And I stood behind him and I was just blown away by what he could do in Python. It was the first time I'd actually seen a coding language in action. And that was the trigger for me. That was really when I decided this should all be done quantitatively and it was possible. And I went and I actually ended up learning to code in R. And at the time, I bought a whole bunch of books and learned to code from books, which nobody does anymore. But that's how I originally learned how to do it.
Yeah, I can also remember myself coding R during my times at business school. When you think about what you did as a fundamental portfolio manager and now what you're doing at a quant, how do you think about yourself developing on that path? Like, I think one of your fundamental ideas is what's getting better from a credit standpoint versus what's getting worse.
Yeah, and I think that articulates very well how I think about the world and credit, that there's the known part is the yield. You know what you're going to earn, or you think you know what you're going to earn. And the unknown part is how that yield changes or if that company gets better or worse. And those are really the two components to credit, the only two components to credit. I think the biggest insight I had one of the insights I had as a fundamental analyst was that I was very bad at predicting the future. I fundamentally lack the hubris you need to be a great risk taker. I don't believe my ideas are the best ideas and I'm the only one who's right. And I wish I did. I think life would be a lot easier sometimes. But I understood, I think, very intuitively the base rates of my own ability to predict the future, and they were pretty terrible. And so eventually, what I wanted to do, and what I really like about quant, is you don't need to be correct on any specific name, but you do need to be correct about what names generally get better and what names generally get worse. So for me, I think one of the learnings as a fundamental analyst is that's very hard to do on a fundamental basis, and it's much easier to do on average as a quant investor.
While in equities, usually the data quality is relatively good, corporate credit data is really messy. So you have OTC markets, pricing is super spotty. Then you have like bonds who are only traded a couple of times in the month. And in addition, you also have the issue that some, or at least in Europe, that's the case, some issuers are private and their reporting standards are also subpar. So it's much tougher to create a strong high yield database compared to creating, especially in blue chips, a strong equity database. So how did you approach that issue yourself?
Yeah, and so this is the hard thing, especially when I started doing this, which was sort of you know pre 2019, sort of there were no really good bond databases available that did the most basic thing, which was to marry bond data to equity data. And for somebody who comes from equity, they never understand this. But you could figure out, you get the data on what the bonds were doing, but then you had to manually match it to an equity. And you could do this by tickers. You can do this a whole lot of different ways. And the second thing was that even once you did that, the unique identifier for the bonds changed, right? The bond gets issued, it has a 𝗙𝗹𝗃, and then 6 months later they change it on you because it became registered, which is sort of bonkers. And so just by necessity, I had to build my own database to fix those two problems right out of the gate. Now, over time, people have started to sell databases that do this. So this is I think for anybody starting now, there's probably better ways to do this. But because I started having to do all this stuff myself, I still have a lot of processes that still do a lot of this. But I think I'm lucky in that I typically work in U.S. high yield, where we have quarterly reporting at fairly high, very high quality. To register a bond in the U.S., you have to report quarterly. And I have not, I'm intentionally not expanded things like private credit or European credit where that is more difficult. I think there's huge opportunities there. And I can definitely do it, but I think it's one of those things where data quality is still a problem, and building the data set is the very first and the hardest thing to do in credit.
I think another very underappreciated angle in quantitative credit investing is that the US is such a broad market compared to Europe. So it also lets you really pick your spots, whereas in Europe you only have like very few issuers in, let's say, a certain industry, which makes it much tougher to really find, I would say, a strong set of credits which you can put in your portfolio. You have described corporate credit fundamentally as a savings vehicle with designed risk rather than an equity replacement. So we see a lot of charts who say, okay, high yield performs relatively similar to equities. Can you unpack how you think about the role of high yield or high yield long only credit in portfolios, and also define who investor should invest in credit and who shouldn't really be in that in credit at all?
Yeah, and I think you said it well. I reject the premise that credit is a hybrid instrument. It is its own thing. Investment grade bonds are, in my mind, not treasuries plus a spread. There is no risk-free government portion of the yield. If your AI bond defaults, they don't hand you the treasury portion of your investment and say, sorry about the spread. No, they say, sorry, welcome to the creditor pool, right? So in reality, there's no such thing as a risk-free portion to a corporate bond. By the same token, high yield is not equities and drag. It has far better downside protection, far lower losses. It doesn't offer the upside, but it does offer you a very attractive yield for low downside, and that's I think very, very attractive. So I think credit is its own entity and should be thought about like that. Once you start to think about credit like that, you can start to think about how to invest in credit. And I think the answer is you don't try to get equity-like compensation, right? And I would define equity-like compensation as anything over 10%, right? You can get 10% compensation credit, but that's not the norm, right? Who should be investing in credit? It's people who want to be reasonably assured of a return over the medium-term time horizon, Forget thinking about duration. If you want to look ahead 3 years, on average, because it's a contract, right? It's much more likely to pay you back within in a 3 year period, right? Maybe not fully, but you'll be able to sell it, and you probably won't have losses. So it's people who need that kind of certainty that should be invested in credit. Now, that might be an insurance company who legally has to have that certainty. That could be an individual who just doesn't want to take the downside, right? That could be me who invests in credit for my kids' college funds because I want to make sure that money is there when I go to pay for college. And so what I'd love to do is step you through a slide that I made that compares the distribution of high yield bond returns to the distribution of their equity returns. Is that something we could do?
That sounds perfect.
Yeah. Yeah. So in slide 7 on the deck, I have a slide that I'll describe it for listeners who are listening. It has 2 lines, and they are the distribution of returns for high yield bonds since 1996, from the worst percentile to the best percentile, and the distribution of equities. And you can imagine 2 lines. Let's start with the equity line. The equity line is pretty much a diagonal with sort of an S shape. So a dive down on the left-hand side and a hook up on the right-hand side. And so for the worst percentile of equities, you have a negative 97% return, median return, which makes sense. The equities go bankrupt, returns go to zero. The best 100th percentile, and these are for the equities of high yield bonds. So we're comparing the same companies. They have a median return of 255%. So you can make a lot of money when your stocks do well. And if you look at this chart, for the equities, the 25th, 50th, and 75th percentiles are negative 19, 4, and 32%. So 2 observations here. You make more money on your winners, right? 32 is greater than the negative 19, and the 255 is a lot bigger than the negative 96. And just over half the time you make money, right? The line actually crosses at the 45th percentile. And this is a game that people understand really, really well. You make most of your money in equity from your winners, and your losers aren't as bad. So on average, you win, but this is really risky. Okay. Now you look at the bond line, and this is high yield bonds, same as the equities. And the worst percentile has a median return of negative 55%, which interestingly, for those of us who work in credit and you think about, loss rates, losing 55% on a bond feels about right in a default, right? Maybe it's 40, maybe it's 70, but that number feels just about right. But the best returning percentile is 54%, 1% less than, it's not perfectly symmetric, but very close to symmetric. The 20th, 50th, and 75th percentiles are 3.3, 6.8, and 10.4, almost perfectly symmetrical. But what's really interesting is the line doesn't go negative until the 10th percentile. And that's the takeaway, right? Credit is incredibly predictable. You shouldn't be expecting a huge upside. Only 54% in the 1% case. But you invest in credit because you want the certainty and not the uncertainty. And you can never sort of forget this chart when you're thinking about credit. So people who are going into credit and saying, I want to make equity-like returns, it's probably not going to happen. But if you're going into credit and saying, I want to make a decent return without the equity downside, very good chance of being able to do that.
I think that's very well put. I think you brought also another slide, that's slide 2, where you basically compare each rating category and show what's the expected yield, so what investors expect to return over a certain time period, and what the actual return is. It's very staggering that the more risk you take, so the lower you go on the rating spectrum, the higher the expected yield, but at some point the return tapers down. Greg, please give us an understanding of the reason behind that.
Yeah, and so this goes back to, I think, the core of our philosophy on credit. And we've written 2 articles, and I'll just talk about them quickly because I think they lay this out very well. I think in 2019 we wrote an article called "Fool's Yield," and the idea behind it was exactly this: that if you look at and I'll read off this chart right now. if you look at since 1990, I think in this case, it's since 1988, right? The average yield on high yield has been 9.5%, but it's returned 7.6%. And the reason is that while in the BB category, the highest category, the yield's been 7.7%, and it's actually returned 7.9, so just about the same. In the B and the CCC category, the yields have been 9.4 and 13.9 and returned 7 and 6.5 or 6.8. So you thought you were going to get these really high yields by taking risk, and instead you actually earned less than you did in the BB. So the BB, just a reminder, earned 7.9 versus 7 for B and 6.8 for CCC. This is from Bloomberg. These are the index data. This is not my data. So when I show this chart, I very intentionally use public data because I think this story is something that people understand intuitively, but they're always shocked when they see the actual numbers. And then we read a second piece called Yield is Not Return, in which we made the exact same argument all over again. And I think when we look at this, we say, hey, this is the reality of credit. But the best predictor of your return is yield. Quantitatively, if you want to know what you're going to return, you have to start with the yield. So when we think about credit, we say, okay, yield is our anchor. We believe that we should start with yield, but now we need to define something that I'll call loss yield. It's what the art is not figuring out what the yield is. The art is figuring out about what's the yield you're not going to get. And that is very, very hard. And that is actually where we can start talking about factor models. But it turns out that using factor models is a good way to try to predict that loss yield. So in the deck, I walk through a few slides, and I'll walk them through them very quickly. And then I'll get to sort of the punchline, right? Which is that you can see on slide 2, which is the slide I just talked about, where as you go down the rating scale, your loss yield is higher and higher. That means, and we're on slide 3 now, that when you look over long periods of time in high yield, if you look at the yield, it ends up being a ceiling on your return, right? That tends to be the best you can do. You exceed it in some years, but if you look over a long period of time, it's really especially over a 3-year period, that's sort of the cap on what you're going to be able to return. In investment grade, it's a little different, and this is slide 4. The line sort of goes, your actual realized returns are either side of your yield line. So yield is a pretty good expected return in investment grade because there's not a whole lot of default. And then in slide 5, we just break this out so you can see what the loss return is for every single rating category. And I'm just going to tell you what it is. It's effectively 0 in investment grade, effectively 0 in BB, but it's negative 2.4% per year in single B and negative 7.1% in CCC over time. That leads you to an average of 0 loss in high yield in investment grade, but about a 2% loss in high yield relative to yield. So what do you do with this? Well, and I hope this is, I'll go through the detail how we then think about this on slide 6. If you focus on this loss yield, what you realize is that if you pull out the yield and you just focus on the loss return, you then realize that the loss return is really a function of the change in yield and duration. And what's good is duration is known. So everybody thinks about duration as being rate risk. And again, when I say that equity and credit is its own thing, we don't think about duration as being rate risk. We think about duration as being leverage, right? If your yield changes at a high duration, it's a bigger impact. It's leverage, but it's known. We know exactly what it is at the beginning of the month or the beginning of the week or the beginning of the day. So all we really then care about is change in yield. And this ends up being a really powerful mechanism for modeling, because then all we have to focus on is what do we think the change in yield is going to be over a certain period of time. And that is a much easier problem because now we've really simplified it down and we can build quant models that focus on that. So I'd be happy to talk about that a little bit more.
No, that was absolutely fascinating. And I think it also fits in from what my experience tells me. So I had also a meeting last week with Moody's, and they also told me 70% of triple Cs eventually default. So that mirrors exactly what you just said. But maybe taking a step back, could you walk us through your process step by step? So let's say you start with a universe, bottom of investment grade and upper high yield. How do you think about liquidity, size constraints, and what sectors do you avoid or handle differently? Just get a handle of how you start approaching the universe.
We start by really focusing on the high end of the high yield universe, and that tends to be where I focus a lot of my time. There's plenty of money to be made in the lower end of the universe. The data is actually more spotty, as you know, more private companies, and increasingly there's less data down there. So, just for somebody who's quantitative and trying to build large data sets, investment grade's incredible. Double B is really good. Single B is okay, and triple C is pretty terrible. Right now, it's small. So we tend to focus on that upper area. When we're building portfolios, I mean, this is not a hard and fast rule, but you can think about us as being, for people who are more deeply familiar with the high yield market, we're sort of B1 and up generally. And when you break those charts I just showed you down into sub ratings, the cliff is really between B1 and B2 when your loss yields start to really pick up. But even within that sector, even within double B's, loss yield is really important. There's a huge distribution of companies that actually do well and earn their yield and then don't, right? So that large story I just told you is also mirrored in double B. It's mirrored in investment grade as you get onto to the bond level. So we do focus in that area. So again, going with the philosophy we talked about, we tend not to focus on duration. We don't tend to take a lot of duration risk. What we're really trying to do is take credit risk. Your yield, again, sort of maximizes in the 3 to 5 year point, and then it's flat going out. And that's because of leverage, right? You get a levered benefit to being longer duration. We will take some duration risk on names that we think are going to do really well, because that's leverage. But we're usually trying to build portfolios that have some certainty of return over a period of time. And that means at least controlling duration. And in the back of the slide deck, I have a chart that actually talks about the duration of the high yield index. And it looks like I think the market is generally going to this. So it's not just us that people are looking at credit. And the slide 9 shows that the average duration of the high yield index across all rating categories sort of is falling towards 5 years. I mean, that's not, sorry, average maturity of the high yield index is falling towards 5 years, which is remarkable. It shows you where people are going. I think more and more people are looking at credit and saying, this is pretty attractive from a yield perspective, but I don't need to take the duration risk. It's risk without compensation, especially in today's environment. And it was not true up until about 2021, 22. So that's where we're focused. We're really focused on that area. We then rack and stack every single bond by where we think the loss yield is going to be, and therefore the total return. So we, over a 3-month period, will project out. We know the yield return. We'll project out what we think the change in yield will be, and we'll get to a total return on the bond. We will also we will always have a cyclical overlay to that. So our models will be more conservative when spreads are tight and a little more aggressive when spreads are wide. But generally, we're doing racking and stacking the credit to come up with an expected return.
How do you think about cyclicality in business models?
Yeah, so incredibly hard to model. We do this a lot as a firm. Our general philosophy is that we're very good at describing and observing what kind of environment we're in. And therefore, we can look back to similar time periods in the past and see what happened, much like other people do. We are very humble about our ability to predict how that environment will change, but we understand the base rates of that change very well. So we know that if we're in a low spread environment now, we're likely actually to be in a low spread environment going forward, but also potentially higher. In high yield, it's a lot easier, right? It's just the high yield spread gives you a lot of the information you need to know. Perhaps inflation will become more important in those models, but we don't have a whole lot of data yet. That's been interesting. But we definitely, in my high yield models, when I'm predicting yield and change in yield, the models are sensitive to the current level of the high yield spread and will be slightly more bearish in tight spreads versus wide spreads.
How do you think about different industries? So you probably exclude banks, but how do you think about, let's say, real estate companies or also energy names, which are usually not that easy to model on EBITDA figures than, let's say, retail name?
Yeah, bank and energy are the two that I think are really interesting. I don't do a lot of banks. That is changing, but it's not changed yet. The energy, I'm a former energy analyst, so I'd love to talk about energy. So we've done actually quite a lot of work. Well, actually, as an energy analyst, it's near and dear to my heart. Energy is a wonderful return on asset business. It is the one place where return on assets works really, really well as a measure. And when I was an energy analyst, I used to go through all the reserve descriptions in the back of the reserve. The last disclosure in the 10K was the reserves. And you can do some wonderful analysis with that. And I used to say, throw out the first part of the 10K and just look at that, and look at what they're producing per, and you can rack that. Racking and stacking energy companies is super easy. It actually turns out you can't predict them at all, but you can rack and stack them. So that is one reason I'm very humble about my ability to predict companies, is because I was working in energy as an energy analyst in credit. So you were just wrong all the time. But the companies on the left side of my sheet did really well, and the companies on the right side went bankrupt. So you knew you could rack and stack them, right? And so I actually say that, for a quantitative investor, energy is wonderful. Energy is it's a return on assets business, and you need to rack and stack those companies by their return on assets, and it works really well. And it doesn't work as well for a retail company at all. That is a completely different thing. So that's where profit metrics matter a lot more: gross profit to assets, volatility of earnings, all those metrics that you would look at for a retail investor work, but not for energy. So it does really help to have different models for different industries, or to have a lot of different metrics across all industries. I've done a bit of both, but I'd say that industry level modeling really does help a lot.
Okay. So after you have niced and diced all the data, which is presumably very hard, you have all the basics to basically build a multi-factor model. Could you explain to listeners how you construct these multi-factor models for a credit portfolio?
Sure. And what I'd say, I'll start by saying these multi-factor models actually, I think, work better in credit than they do in equity. Credit is, once you break it down to change in yield, it's a contract. So credit's relatively predictable. And while the data is harder, actually running the models is potentially a little easier. Okay, so we build factor models in equities. We build them in a lot of things, and so we're very familiar with factor models. There's always three things that you start with that always seem to work in factor models. One is a value metric, one's a momentum metric, and one's a quality metric. We'll start with the quality metric first, just because it's easy. It's pretty much rating in credit, and we've already talked about where the returns peak. So I'm not going to go on that. The value and the momentum metrics are more interesting, and there's other metrics we use too. But these are the three that matter in every credit model. Momentum is a really interesting one, right? And I think it brings up a huge it illustrates some of the difficulties of modeling credit. In equities, momentum continues, right? Unless you have a momentum crash, and usually that's when spreads are really wide. Generally, stocks that are on average that are going up keep going up and continue, especially in stable environments. In credit, that is true in investment grade, and it is not true in high yield. So momentum is actually dependent on rating. And it's also dependent on how exposed to rates it is. So because rates trend.
So what you're saying is basically in IG, you have a mean reversion, whereas the further you go out towards the rating spectrum, towards, let's say, 𝗙𝗶𝘃 or single Bs, you have much more momentum, right? So if something goes, it really
Correct.
goes, and the other way around.
Yeah, and so exactly. I said, and let me rephrase that. So momentum varies by credit rating, and investment grade, you tend to have mean reversion, right? So if something has gone up, it comes back down, and that's because it's a contract, right? And that happens all the way down to 𝗙𝗶𝘃. So momentum is actually a mean reverting metric in credit. It is not once you get down to single B and 𝗙𝗶𝘃 where you have continuation, right? If a credit is going bad, it tends to keep going bad. If credit's getting better, it tends to keep getting better. So that introduces a very difficult wrinkle in building credit models, which is that the coefficients on the factors actually change by rating. And there's mechanisms to deal with this, but you have to really be aware of how credit works in order to build these models. And then you have to make decisions about whether you do an interaction effect and whether you build models within certain rating categories. And I won't go into those details, but I don't think there's a really easy solution to it, but you just need to address it. So that's where I think momentum illustrates some difficulties with building factor models in credit, but it also works really well. Value, I think, is probably the most interesting thing. And here, you can think about what we do as assigning our own ratings to bonds, right? And if you look at a bond, you can sort of think that, hey, that bond is trading like a double B, but my factor model thinks, or my fundamental model thinks that's a single B. Therefore, the spread will widen and the price will go down. That is a quantitative approach that is identical to a fundamental approach, and that's true. And there's a lot of different ways to build those models, but I'll say a few interesting things about them. One, again, if you project a change in yield, it's going to vary by credit rating. 𝗙𝗶𝘃s are going to move a whole lot more than investment grade, and you have to normalize for that. Two, there's a question of, do you use the agency ratings or are you a replacement for the agency ratings? And here I think we have, again, there's some humility here. The agencies talk to every single company. And Moody's has been doing this for 100 years. They might not be good at CDOs. They might not be good at mortgage-backed securities, but they are very good at corporate credit. This is not rocket science. They are looking at the same metrics you are, right? They are talking to the companies. They have industry analysts. It is an incredibly valuable source of information. And where, I think when I talk to fundamental managers, they love to talk about where the agencies were wrong. And my view is they're probably wrong on every single credit in some way. But on average, they convey a lot of information. So we very much look at the ratings and take them into account. And I think you and I had talked about this offline a bit, and you were asking me about cyclical industries and how to deal with cyclical industries. What you want, and what the rating agencies do very, very well, and they're very explicit about this, is they try to assign a rating that is stable through time. And that means that if you're an analyst who is trading, they're going to be wrong. They're going to be too high when the company's going down, and they're going to be too low when the company's maybe going up, but they're going to be sticky. But that's really, really useful for cyclical industries when you're racking and stacking companies. So I think if you appreciate what the rating agencies do as an input to your model, where you're trying to come up with your own rating, I think you have to pay attention to them and incorporate them into your model. And we definitely do that. So, but that gets to the sort of the value. But going back to Quant, we come up with we'll call it our own rating and compare it to where the market is rating the entity to try to predict where the yield is going to go. And ultimately to get to that change in yield, to get that loss return, to get to that total return.
What would you say is the most important driver in your multi-factor model? Can you pin that down?
I'll say the most surprising factor that really, really matters, that we don't do any work on, size. The bigger you are, the less likely you are to default. I think one of the beautiful things about doing quant is I thought I was going to find all these, and I did find some amazing factors, right? That, the really sexy factors that are just hidden and nobody knows about. And there's some really cool stuff we found. But the thing you have to put in your model is total assets. It really, really matters. Think about a fallen angel credit, right? Fallen angels are known to be some of the best performers in the market over time. It's a combination of the fact that they have high duration and that they stop getting worse once they go into high yield on average. But if you actually, and we've done this study, we didn't publish it. We looked at fallen angel credit metrics versus just double B credit metrics to say, okay, maybe what's happening is you have some really good companies that are falling into high yield, and therefore their credit metrics are actually better. So exactly the same. The rating agencies are rating them double B because they're double B. So it's not, there was no surprise there actually in retrospect. The big difference is size and scale. Investment grade companies that fell down to high yield probably had a business model that worked at one point, so they got big. They had something there. They have hidden assets they can sell. They have really entrenched workforce with a lot of experience. There's a lot of positives that accrue to being able to have had the capacity to build a lot of assets that aren't obvious from the financials. So that's sort of the surprise metric. I think that really, really matters, total assets. Then there's the fun ones. I think we can go, building the value factor. That's where all the fun is. That's where you create specific industry models. You choose different metrics. You have an energy model. You have a banking model. You look at insurance differently to come up with how to actually value a company within its industry and then relative to other industries. And so I would say the next most important factor is coming up with that value factor and doing that in a very creative way, which incidentally is a fundamental exercise. We're just translating lots of fundamentals into what we think a bond should trade.
How much do you lean on the equity side of the issuer? So let's say, I think equity momentum is super important.
Yes, very much. I would say total enterprise value to debt is a really important metric. And it could be the only metric you use at some point. You'd probably be fine. If you use rating and total enterprise value to debt, you'd probably get a long way to building a viable model. That gets really complex when there's no total enterprise value, which is a totally different problem. Yes, we very much rely on the equity data. I think as a firm, as you know, we run a bunch of equity funds, and I actually work on those equity funds as well. All the problems are the same, right, in debt and equity. So we don't really see a difference between the factors. We have very specific credit factors, but when we can apply equity factors to credit, we definitely do. There's more work coming on that from me, but you guys will have to wait for that.
I bet a lot of fun work. One thing as well is correlation. Correlation has increased quite a lot over the last 20 years. Everything correlates in stress. How do you think generally about correlation structures across issuers and sectors? Is that a thing you keep in mind, or do you think it's not really important because our approach is more of generating a stable return over a certain amount of time and not at a certain point of time?
So really gets back to the distributions of returns question, which is that correlations in equities matter a lot when you can go long short because there's an opportunity to short very actively. If 45%, the 45th percentile is negative, there's lots of opportunities to short out factors, to really care about those correlation structures. We definitely do all that work. We don't do it as much as credit. Number one, the returns go negative at the 10th percentile, so there's just not as much opportunity to isolate those factors. And two, when you actually decompose sort of what drives risk and credit, duration and rating is a lot of it. And you're very often making just a decision on your total risk is driven by what your average rating is and what your average duration is. And you can trade off between those two things. Sometimes it might be better to have more credit risk. Sometimes it might be better to have a little more leverage risk with higher quality. But ultimately, those two things are combined to create a risk profile for a portfolio. And then we just worry about trying to pick out the best returns. So no, the answer is we don't spend a whole lot of time on correlation structures in credit, even though as a firm, we spend a lot of time on correlation structures.
That makes a lot of sense. In terms of portfolio composition, how many names usually go into your portfolio and how often do you turn over the portfolio? And is portfolio turnover really that important? Because especially, let's say, the further you go down within the rating spectrum, the more it is about often turning over your portfolio because what goes up needs to be recycled and the other way around.
As I've done this and as I've built these models and worked with these models and become more comfortable with them, I have diversified more and more. And the reason is that in the early days, I would look at what the model would choose, and sometimes I wouldn't like it as a fundamental analyst, and I wouldn't do it. It was almost always wrong. But you need to have the courage to lean into the top 10%, top 20% of your model. That is a lot easier to have that courage when you're highly diversified. You're also capturing what the model is trying to do. So you're not I'm trying to stop me as a human being doing something stupid that the model by counteracting the model, and instead put all my energy into fixing the model. If I see a problem, then going testing it and building a structure that works so that I've already made the decision by the time the model's telling me to do something. Now, I still make sure the company's not about to be acquired and just announced $1 billion of debt or something. But, I'm trying to follow the model. So that means I'm much more diversified than I used to be. In terms of turnover, again, that depends on, first of all, clientele and what they want. So when you work in fixed income, you very often have managed accounts that have very specific requirements. In our funds where we have a lot of discretion, I have increased the turnover as I've increased the diversification for the exact same reason. As things fall down my model, I tend to sell them more. My rule of thumb right now is just so that I hold bonds long enough that once I fall into the bottom 70%, I really think about, or the bottom 30%, sorry, below the 70 percentile, I think about selling them. The bottom 20% of my models tend to do very badly. As you saw the distribution chart, you can actually sort of imagine in your head where I'd really care. I'm trying to be on that right-hand side with a scoop up and try to avoid the left-hand side with a scoop down, right? In the middle, I don't need to trade. I try to avoid turnover because very often those names will move around that middle piece. But thinking about distributions of returns tells you where I'm trying to focus the portfolio. So I try to buy on the right and sell when it falls down to the left.
Another thing in 𝗙𝗶𝘅𝗙𝗹𝗪𝗏, of course, also the lower in the rating spectrum is corporate actions. You just mentioned it. If there is dividend payout, splits, takeovers, stuff happening like the Warner Brothers story. So that's also an issue in even in IG, right? How do you think about incorporating that quality aspect, which can't be modeled quantitatively?
Yeah. Well, again, good things happen to good companies and bad things happen to bad companies. It's just the way I'd say that, right? Uh, Listen, I get surprised by corporate actions all the time. If you work in bonds, and for people that aren't trading them, if there's anybody listening who doesn't trade bonds day to day, there's a crazy thing where all of a sudden they'll just make an announcement and offer to you and say, "Hey, we're going to strip all your covenants unless you agree to do something." Right? They'll pay you. You're getting paid, but you haven't been paying attention.
Yeah.
Right? It's a attention job. So you have to answer these corporate actions. You have to be paying attention to what's happening with these bonds, which is wild for somebody in equity where they really don't think about it very much, right? But the answer always comes down to you can't predict it very well. Often, but most often, I was in the loss return chart. What I was glossing over is that the the returns to investment grade are slightly positive, the loss returns. You actually get a little extra above the yield. And there's two reasons for that. One is that the bonds drop out in that data that I was showing, the bonds drop out at a year to maturity. So there's a positive, they usually price slightly above par when they drop out on average since 96. But there's a second thing, which is that corporate actions generally benefit those companies. There's calls, takeouts. Those corporate actions are a positive. And they are a positive through, if I look, I'm just on average, and I wouldn't read too much into it, but the loss return is positive through double B. So corporate actions are, again, good things happen to good companies. You're likely to get taken out. You're likely to get acquired. You're likely to get tendered. A company does really well. They have a non-call life bond. They tender for you above par, and you actually get more than your yield on average over time. So I would say, yes, my philosophy is good things happen to good companies and bad things happen to bad companies. Don't try to make your return on the bad companies.
Just to get this straight, you just said that the loss return on double Bs is positive. How can we think about it, or how can we understand that?
Yeah. So 0.2%. So it's basically zero. It means that in the data that I'm showing here, the return you would have expected from the yield is actually very slightly below the return you actually got in double Bs. So you actually earned your yield with in this data, and this varies by time frame, right? So this is not a hard and fast rule. The way this can happen is that if a bond gets called early, right, you actually it gets paid back. You get paid back at 101, 102. You actually get paid back at more than par. Or in the case of this data, the bond drops out of the index with a year to maturity. Because short-dated bonds have low yields, it usually means the price is above par, so that you're actually seeing something that's not real. The bond matures at par, but it gets taken out of the index above par. But what it's telling you is that if you're above par with a year to go, you're probably going to make it. It's telling you that the results in double Bs are actually the losses you get in double Bs on average are offset by the gains you get in double Bs that are in excess of what you expected because of early actions, calls, mature takeouts. So
That's super interesting. Another key finding is that your model seems to be more reliable on the downside than on the upside. Can you also explain what the drivers
yeah.
behind that behavior is?
Yeah, so when you look at any factor model, and this is going to be a true statement across equities as well, and we found this in equities, that you that factor returns are when you read the academic literature and they show a factor return as the top decile minus the bottom decile. That return is very often driven by the performance on the downside, the bottom decile. I was just reading a paper on momentum. This is very true for momentum. The momentum factor works because the downside part is where you make your money. For credit, that has some important implications. If you're not shorting, it tells you what to avoid, right? And so that bottom 30% of my model's pretty good at telling you what not to go into. And that's why I rebalance out of it. I mean, I would argue that my rebalancing out of that is as important as my credit selection at the top of my model. Because if you can cut that out, then you can actually deliver hopefully a 0% loss return, maybe something positive as it goes up. So, and so I've showed this long-term loss return data. What I'm trying to do is my time frame is 3 months. So I'm projecting out 3 months and saying what's going to happen to the yield over the next 3 months. And do I think it's going to tighten or widen relative to the universe? And hopefully getting a positive return in addition to the yield, or in an environment today where spreads are incredibly tight, minimizing my loss and still earning a yield. So my models right now, most of the bonds are showing a price loss, an estimated price loss, because spreads are so tight, which drives duration in and credit rating up. Effectively, and not really my models really do credit rating, but it's driving my model to want to be short of duration. It's not. It just wants to take yield and not lever losses. And so you see so that's the way the model's working right now. It's very smart, right? It's sort of saying, hey, we really like these yields. We think they're good. We think we're going to get them. But there's a risk that we're going to lose some down here.
So what you are saying,
but not enough. Not enough to offset the yield.
So what you are saying here is basically that the yield overall is good, but you could have some losses because the credit quality doesn't really compensate. Is that how we can think about it?
The model thinks that yields on average will probably get a little wider, and that therefore you'll have price losses, and therefore you don't want to magnify those price losses with duration. So it'll already estimate a price loss for credit, right? So those price losses are always there. The bad bonds are still the bad bonds, but now it's saying actually in your good bonds you might lose a little bit too, but you're still going to make some money, and you're going to make money more. It's not you're still doing okay. But I think that's where the market is today, and I think you're seeing that in credit right now. Very tight high yield spreads, people bringing down duration, issuing shorter duration. That is the story of the credit market right now. Attractive yields, not particularly attractive macro backdrop, but nothing, nobody's hitting the panic button.
So you are saying from your model, it makes sense to go shorter duration and also up in quality.
Yep.
And also especially avoid potential losers, given that they have so much negative convexity embedded in them.
Yeah, and actually, my models always try to avoid losers. So that's sort of a that there's no change there, right? It's out now. It's saying even on the ones that we really like, we're going to take the duration.
Switching gears from credit towards one of the topics you have spent a lot of time on, you and your team have done a lot of work on biotech, a sector very hated. Could you walk us through your process for analyzing biotech? It is a super complicated sector, and I guess it's also very different of what you would expect from analyzing other industries.
Yeah, sure. And there's some context needed here, which is that, at Verdad, we run a bunch of equity funds as well as debt funds. Over the years, as I've built debt data, I've also built equity data because it's the same thing. And so the firm really works together. When I work on my credit models, I work with a whole team. And so we're a very integrated team that is much more, has a quantitative foundation for doing a lot of different things. And last year, Dan, who runs our firm, became very interested in biotech because there's a few things about it that are really interesting from an investor standpoint for what we do. It's really the largest part of the small cap universe. Whenever you see people say that 55% of the small cap universe has no profit, a lot of that's biotech, right? So you're really saying that there's a lot of biotech. It was beaten up, and yet you really couldn't. You think about biotech as an opportunity, and AI is probably very good for biotech overall. It is a science-driven industry that has been around for a long time. It's not going away. And we want to take a look at it and say, and but it broke our models. So when we went to run our factor models, biotech just breaks them. In fact, the value factor in biotech is completely inverted. So the most expensive companies do the best, and I'll explain why in a second. So we were like, okay, we had to throw biotech out of our models, and we had this big opportunity sitting over there we didn't understand. So we're like, can we solve this quantitatively? And so what we did was very much sort of the same approach I just outlined in credit. The very first thing we did, we just looked at the distribution of returns in biotech. Okay. And 75% of the company, that line that I talked about in credit crosses it about the 70th, 67th percentile in biotech. Most biotechs lose money. Okay. So from a factor perspective, you really would love to have a long short factor model here. I mean, this is the opposite of credit, right? Where I'm sort of saying, I don't know if I want to do long short because it's too hard to short. And no, in biotech, you absolutely want to do this. So the challenge was to come up with quantitative metrics that work. And I'll simplify this by saying, as I said before, there's always three metrics that work: value, quality, and momentum. None of them work in biotech in the traditional manner. So let's talk about value at first. We tackled this one first. The problem with biotech is it has no profits. And when we did the value metric, the reason it was inverted was the companies that were spending the most money, that had the most negative profits or most negative cash flow, did the best. So we just inverted it. We said, well, actually, okay, if you're spending money, that's actually an investment. That actually makes sense. The best companies, because clinical trials are expensive, if you're spending money, you probably have something that's probably a good thing, not a bad thing. So we literally inverted the profit metric, and we're just shocked to see that it worked really well as a value metric. So if you just do, you have to take cash is weird in biotech, so you have to take out cash. But if you just do enterprise value or market cap relative to spending, it's a terrific metric in biotech. It works like a value metric anywhere else. So that was the first step. The second step was quality. Well, this is a really tough one. The canonical quality metric in equities is gross profit to assets, a measure of profitability. In energy, it could be return on assets, but we know what quality is in equities. We didn't know what it was in biotech. And nor did we really think we had a good way to find out, because quality is future size of the market and your probability of getting there. Well, it turns out there's a whole group of people that do nothing but opine on that, and that is the specialist biotech funds. And they file the 13F. So there's about 70 funds we rank as specialist biotech funds. The metric is they just have that 50% of their investments in biotech. So these are specialists. They're very good. I mean, the RE Capital is the example of somebody who's done very well. But these are people who have teams looking at biotech. And it turns out that, it's not about finding the specialist biotech fund that's the best. When all biotech funds are invested in a company, that tends to be a very good quality signal. And in fact, the opposite is also true. If you have a lot of investors, a lot of funds invested in a company and zero are biotech, for a biotech company, a biotech specialist, that's a really bad indicator. You don't want to be invested in a company that a whole bunch of funds love, but none of the biotech specialists like, because they've done the work. Specialists are very good at what they do, and they're an incredibly good quality indicator. So that worked as well. And that left momentum. And this was probably the toughest nut to crack, right? And we weren't trying to crack momentum in general, but what we're trying to do is say, hey, listen, we know equities, momentum that tells you nothing in biotech. It just doesn't work like the rest of equity. It's too volatile. There's some meaner version, some continuation with no rhyme or reason. We couldn't figure it out. The trick ended up being categorizing the companies. And how do you categorize the companies? Well, we spent 6 months building a clinical trials database where we got many thousands, hundreds of thousands of clinical trials. I can't remember the exact number. Scraped all the data down and matched them to companies over time. So now we have incredibly good clinical trial database, which is effectively the SEC filing of the biotech world, right? This is the SEC filings for they have to be checked over. They're standard form. They have all the data you need. Well, that became our source of truth for biotechs and allowed us to categorize them and to create a similarity metric that just said, how similar am I to every other biotech out there, right? I'm 4% similar to that one, 2% similar to that one, 90% similar to that one. And then if you looked at momentum on that metric, it works really well. And that is the unlock for finding a whole bunch of other metrics too that I won't go into. But that's actually, so we we just published a white paper. It's on our website. But it's a really good example of every industry. I think you would think biotech's not an industry that you could look at quantitatively. It turned out it's ripe for the picking to do quantitatively. And because, as I said before, quant's best on the short side, and because biotech is such a fertile ground for shorts to offset your longs, it's a really interesting place to invest.
That sounds super fascinating. I've actually read the piece and think it also fits generally in your very quantitative research-based approach you have at Verdad. Generally, what would you say have been the biggest lessons from building and running quantitative strategies, not only credit, but also in equity over the past couple of years?
Just what I would say, there's two big observations: that quant is still a fundamental exercise, that building factors that make sense, that work, is difficult, and it's a creative process. Two is that the process is as important as the model, and having a good process for checking your model, improving your model, tracking your model, seeing how it's doing, just a checklist of things to improve is super important. And building that research and execution mindset into a firm, so that you're constantly learning and building and then implementing, right? Modeling it, putting it in code so that you can run it. I think it is not moving to a quantitative process is not a discrete sort of finite operation. It's a continuous improvement operation that never ends. And it's really, and I would just say it's really fun. It's really fun to work that way.
I do agree. What you just said is basically you need to have a cyclical process which keeps on repeating and repeating, and it will never stop. What are the most common mistakes you do see in models, also in credit models, let's say like overfitting, trading costs, and other things, or for what people should watch out for?
Yeah, I mean, other than the obvious pitfalls that no matter how experienced you are, you still fall into, like look ahead bias. You have to make sure you get a great result, that you realize you accidentally put look ahead bias in there and things like that. No, I would say the pitfalls is expecting too much from the models in terms of. I'll tell a story. So when I was on a fundamental desk, people would say, "Look, what's the model's best idea?" The model's best idea is going to be a dumb idea. It's going to be a stupid idea, right? The model's top 10 ideas are going to be fantastic, right? And so I think the biggest mistake that people make is then trying to just look at single outputs from the model and judge the model on that. You have to judge it holistically, and then you have to have a very strong bias towards making all your fixes in the model itself, and not at the end. It's important when you first start a model to make those fixes at the end, because but as it learns, you want to move your process as far back as you can into the process, all the way back to the data ingestion, and getting good data to build good models to then build something. So I think that's probably what I've learned, is the importance of that, and that's slow. That's slow and hard, and takes years to build. But that is, you only need to model something once, and then you've got it. It just churns. So you want to make sure that whole process is really solid.
Greg, this has been fantastic. Before we wrap up, where can listeners find more of your research and work at Verdad?
verdadcap.com, or just look up Verdad Capital, VERDAD, has a large research library, and we have a weekly email we send out and have for 10 years now, a Monday morning research piece. And it's rather incredible that it comes from a small firm, but you will see the entire archive on the website. And if you want to get the email, you can sign up for the email as well.
I'm also a vivid subscriber of your research. It also covers interesting thoughts and research on Japanese equities. So it's really broad based, always really backed up with actual research. Greg, thank you so much for coming on Fixed and Floating. This has been one of my favorite conversations so far, from PM to PM. And also thanks to everybody listening. If you've enjoyed this episode, please follow or subscribe wherever you get your podcast, and see you next time on Fixed and Floating.